Hello traders, Gary Wagner here, approximately 8:45 in Honolulu, Hawaii. It is Thursday, the 8th day of September, and this is the daily report for gold. We have gold continuing to trade higher, up between $38 and $40 higher, currently trading at 18.5854. That's basis the cash. December COMEX is at 1861.20, about a $3 difference between the two. On today's report, we will talk about the distinct possibility, or the assumption I should say, that we have currently not concluded the correction that began as this market hit a new record top at 1921, and that was just a few days ago on the 5th day of September. Now, the first chart that I do want to look at today, I want to start with a couple of short-term charts and then we'll move out a little bit. And this is a 60-minute chart. It is in Henkin format, meaning a Japanese average format. And you can see that we've also entered our Elliott wave count. Of course, it is our current belief that after reaching our concluding fifth wave, this impulse wave, which concluded right here at our former top, we went into a corrective phase. Our belief at this point is that it is an irregular corrective wave. An irregular simply means that our B wave, which is our counter wave to a corrective phase, is going to be higher than our orthodox top, as you can see here. Now, this wave, as we talked about before, is going to be composed of an A, B, C down, then an A, B, C up. And the A, B, C down gives us our large A, and then our B here. It is also my belief at this point that we have entered a corrective wave C. This is 1, 2, I believe it will be followed by 3, 4, and then 5 down. Now, we just had the Federal Reserve Chairman, Ben Bernanke, speak in Minnesota, and you can see that during that speech, if anything, we witnessed the market kind of stabilize. In other words, my sentiment is that we have been witnessing the old adage, buy on rumor, sell on fact. You can see that these Henkin candles, in terms of size, we had a very, very nice uptrend. You can see by these larger candles here, but you can also see where that trend began to wane or weaken, and that's right in here. You've got the transition candles, you've got a red candle, it goes red, it's now back to green again. This is short term, 60 minutes, but it gives us an indication because, of course, we entered a short position. We were looking for the market to top out somewhere around 1842. It has at this point, gone past that. And let me show you on the chart we've been working with what new areas I'm looking for and where I think this marketplace should find some resistance and begin to move lower. Now, this is a chart that we have been working off of for the last couple of days, a 240-minute straight candlestick chart. And let me go ahead. I'm going to erase these lines so we can see this area a little bit better. But it was my belief that as we came down and this first part of this corrective wave C, my sentiment was we would probably go up to about the 38% level, and that's 1842. It did, and you can see we had this double top here, but it did excel and break through there and is now butt up against the 50% level, and that's roughly 1856. Right in this area, with the stop that we have currently is 1866, although I probably feel more comfortable with that stop at 1872. If you just want to adjust that, you can feel free to do that. I simply want to put it up one more band so that as we have any kind of intraday noise, if this market is truly going to break and break to the downside, we won't get knocked out prior to that. Now, as I said, you can see that as this market has come up, it has found, at least on a tentative basis, some resistance in the marketplace roughly at the 1860 area. It's currently trading 1859. So it's been trading right within that area now for the last few hours, and you can see that each one of these candles represents 4 hours in time, and you can see it has been just trading up against there. Now, when you think about it, as this market came down, it has roughly moved 50% of that move back, and that is typical of a counter wave in the marketplace itself. Now, traders, for the final chart that I do want to look at today, it is a half a day, 720-minute candlestick chart. Each day represents 2 candles. And what we see when we look at it, we see a very, very large compression in time. And you can see these particular moves that we've seen in the market, this A and B, how quickly they really transpired. As I said, this is currently C, and I believe that it will be composed of a series of waves, something like this in terms of where it will go. We haven't plotted that yet. The only real caveat in this scenario would be if we had some sort of a truncated C that ended here. As of this point, I do not see any evidence that would confirm that, but this is an unusual market, and we must keep our eyes open to all scenarios as they begin to brew. Traders, maintain your position and, of course, maintain your stop. As I said, if you want to loosen it, no more than maybe 72, that's basis cash. Add 3 for December contracts. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.